Hello guys, good morning. In this video I will try just to speak more into details about investing in stocks. Now, investing, as the word suggests, has to do with time. It means you are more to stay more than 1 year, and a lot of people, they stay 10 years, 20 years, 30 years, depending on the length, or depending when you need your money. Now, there are some people who have money to invest right now. Some people, they don't have, like majority of the public, like what you say, the public, they have just little money to spend. So it depends on you. You can you can do it like a schedule. Each month you put some money. Some people, for example, who have here in the United States of America, who work for companies that offer 401k, which is what we call an investing plan. It is not, as some people think, it's a retirement plan. It's just an investing, because when you invest, you risk all your money in the market, and the market is not stable. It goes up, it goes down. So there is another thing, that your money, when it is like in a 401k, it is not taxed. And when you have a lot of money later, like 10 years or 20 years, or you begin to have money like 100,000, 150, 200, 500, especially those who are like doctors, like lawyers and the like, that are middle class, they can put too much money there. Now, understand that the tax change, okay? 25%, then depending on your money, it can go to 30%, 35%, or wherever it goes. Okay, so the government later, it will take a big chunk of your money. Okay, let's speak about investing for general public. A lot of people, they buy mutual funds. Now, what do you mean by this mutual funds? Mutual funds is just a manager who manages money of people. So what does he do? He buys the stocks, companies, okay? And there are rules by the Security Exchange Commission. There are rules, okay, he should apply in buying and selling. There are rules for him. So it's a bit tight. So he buys the stocks that he thinks are good to go up, because a mutual fund, he can't short the stock. Okay? If they give them the right to short the stock, all they short the stock, and the stock market will be dead, because they have trillions of billions of dollars. So it's too much money they have in their hands. So the government doesn't want them to do some stuff that make the whole system of stock market fall down. So they don't give them this right. So for you, what does it mean? If you are buying mutual fund, understand that it means the price of this mutual fund goes up and goes down according to these stocks that are there. And understand that stocks, they don't behave the same. Even when we have a bull market, it means a lot of buying. What do you remark? Not all the stocks go up. there are a lot of people, a lot of stocks that go up, which is true because it's a bull market. A lot of, a lot of advertisement by the companies, by, a lot of stuff going on. So they let people, they put a lot of money. They give stories that people are successful, and in 1 year or 2 or 3, and the people, they spend too much, they put too much money. That's why the market goes up. So mutual funds have stocks, and each mutual fund, if you go to check mutual funds, each mutual fund has a collection of stocks. Wherever are these stocks? Maybe different industries, maybe on one industry, maybe, and they try to mix stocks with bonds, with wherever. They try to mix in order to balance, as they say, their mutual fund. Okay. Now, there is a risk. Whenever you put money, there is a risk of losing money or making money. Okay? Understand that there is nothing that it is safe. A lot of people I see online, and I read a lot, and I see online people, what the safest way to invest? There is no safest way. If you buy something, it goes down, you lose money. That's it. There is no safest way. Or some people, they say, you will never lose any money, and because of this and this. There is no such thing. Either you make money or you lose money. There is no, if you stay 10 years with the same price, so you lose time. Even if you don't lose any money, you lose 10 years of investment in your life. So 10 years, it is 10 years. Okay, it's not 1 day or 2, it's 10 years. Okay, so understand that investing is not only because of the money, but of the time also. Okay, now some people try to find what we call ETF, exchange traded funds. What are they? They're just a stock. It's like a stock that attracts an index. It's very, very simple. Any industry, any sector, any index that it has an ETF that tracks it. For example, if you go to the Dow Jones, you find ETF DJIA. This ETF tracks the index, because the index, let's say it's 16,000 or 17,000. Right now I think it's 16,000. Okay, this is just a price for the index, but you can't buy the index by itself. You can buy the ETF, and it follows it. If the index, if Dow Jones go up, you see that your ETF stock is going up. If the index is going down, you see that you lose money. Some people they like just to follow the market in general. They like, for example, someone likes banks. They say, okay, this sector of banks is slow, it doesn't go that much up, it doesn't go, so I want to not to risk too much, so I just go with this, because he sees all the history, like 10 years, 20 years, 30 years of this index, and it doesn't go nowhere. So he tells, okay, I'm okay to have 2% or 5% a year or wherever. After 10 years or 20 years, I will have something. Okay, some they like that. Some other investors, they like single stocks. Some also single stocks. It means, let's say you do your homework, you search for companies that are good according to certain criteria. You can go to investing books and they give you this criteria, but you know, they give you just this criteria, but it's not sure that these stocks will go up, okay? Or this companies will go up. Well, no one knows. If someone knows one stock that will go up 1,000% to 2,000% to 10,000%, okay, all the people put their money there. That's why this idea comes to spread the risk. What does it mean to spread the risk? It means you search for companies and then you find you like 5 companies. They are different. One is a bank, the other is pharmacy sector, the other is food company, processing food and something. One is transportation, the other I don't know. It means you just find 5 stocks that you like. So you begin to buy these 5. Okay, I will try to explain later how to buy. So you buy these 5 and you say to yourself, if 3 or 4 companies goes up very good and one it's not good, I don't care. It means I get the average. And this is what the big investors have done. Okay? Now, for you, you just spread the this is what other people they do. They say spread the risk in stocks. Some other people, they are, I don't say too crazy, but they like risk too much. What they see, they see a company that's going up. Let's say it is $10. It was $3 like 1 year or two. $3 now it's 10. And he said to himself, okay, since this company was 3 and now it's 10 in 2 years or 3, if it continues like this, and I know this company is very good company, okay, I will get money from it. So he put all his money. And he waited 5 years, 10 years, 20 years, and then until he see his money growing. Now this is to take the biggest risk, because you risk all your investment, all your time in one. If you succeed, you will be in newspapers and you will become one of the famous investors of the world, like Warren Buffett. Warren Buffett is the same. He bet on some stocks, and other time in the 50s where the market was so slow, but after just timing, just when he bought, it was the beginning of a long trend. That's why he became a billionaire. But understand that Warren Buffett and the other people understand this: when they buy, they don't buy 100 shares. Understand that they were rich. So don't always, when you listen to Warren Buffett, or you the people who talk too much about Warren Buffett and how successful he is, but he has 2 things that it's extremely rare. I don't say extremely rare, but it didn't happen that often. One is that he bought at that time when just the beginning of the trend is a very big trend. I will show you later with a chart how things works. Now, second thing, he has money. Okay? He has money to buy this kind of stocks. Warren Buffett, when he buys a company, he doesn't buy 1,000 shares, 100 shares, 10,000 shares. No, he buys millions of shares. He has money. Understand that you are not like him, and you will never be like him except when you have his money. Second thing, an opportunity when it comes. Opportunity doesn't come each month or each day or each. It comes in some years. You have one opportunity, okay? When there is a big correction of the market, or when there is a big trend of the market, no one knows. But whenever you are in and you see things begin to go up, that's an opportunity. Okay? Now, other things. Since, like most of the people, what we call the public, we don't have money. We don't have millions of dollars to put in this stock, and then we have millions of stocks to put in another stock. People are, they are just hourly rate or salary, workers, so they don't have that much money. So what they do, you should either buy each paycheck or each paycheck or each month, wherever your money comes, and you do it as always in good market or in bad market. You just do it. You just buy and buy and buy and buy, because the market goes up, goes down, goes up, goes down. The more you buy and the more you have money in the market, it means you have something. If you have 10,000, 20,000, 30,000, and the market has a bull market, this 10,000, 20,000 or 30,000, it becomes 100,000, 200,000, depending on the market. But if you put only $500, even if the stock goes a bull market, you will never get that much. 500, you get 5,000, 7,000 after 10 years or something. But this is not that much. So the more money you have, the more money you can make in the market. So the money is always something very important. That's why Warren Buffett, when he buys, he has money. Don't say, oh, I will do like Warren Buffett. Well, you will never do like Warren Buffett. And the other people, they try to, I find some videos, they say, oh, how to invest like Warren Buffett. Okay, I say, do I have millions of dollars to put in each stock? Can I buy 10% or 20% of Facebook, for example? Like Warren Buffett did with Geico or Coca-Cola or whatever company he has? Can you do that? You can't. So why you say I do like Warren Buffett? You can't do like Warren Buffett. And even the time, Warren Buffett, when he buys in the 50s. Are you in the 50s with him? If you have 10,000 in the 50s, not millions of dollars, and you put it, now you become millionaire like him. But you don't. Okay? You are not in that area because you weren't born yet. Or you were born and you have money. Or you don't know about stock market. Okay? So, some people, as I tell, some people right now, what they do in America here, they do it because of the employer. They give them this 401k and they participate, and their thing become grower up and up because they buy always. Each paycheck they buy. And believe me, it's a good thing. It's a good thing, because they match. Some they match 50% of what you put. Sometimes some they match 100%. And depending on how much money you make, they have a percentage. Okay, this I have explained in another video. The 401k, is it a good or bad thing? Now, what you should do right now in order to become successful, first you can just study a little bit. What are the criteria of to have in a company in order to buy it? So this criteria, it doesn't mean that when you buy by this criteria the stock will go up. No. It's just to make sure that this company is not going into bankruptcy. Okay? If you see a company that it is $100, as someone told me, and now it is $2, don't tell me that you are investing in this company. Because it was 100, now it's 2. How do you know from 2 it goes 100? It's over. So this probability of making money, it's going to zero. Okay, it was 100. If you bought it when it was 2 and it goes to 100, yes, it's okay, but it's 100 going to $2. It's too much. Now, second thing, either you can buy these companies, you can buy each month or each 2 months or each 3 months, you just buy a little bit. You can open an account, a broker account that doesn't have fees for not trading. This I will explain in order to have an idea. Is that try to call your broker before you do an application and ask him, if I don't trade, is there a fee? This fee is called inactivity fee. Some brokers, if you don't trade, it means if you don't trade, they don't make money. And they say to themselves, oh, this guy is not trading, so we can't have commissions. Okay? Now, so some they put a fee. Some they don't care that much because they have too much money, they don't care. They want you to invest because they use your shares and to give it to others for shorting later. But they don't tell you and they don't give you nothing, but they use it. That's why they have certain things they do. Now, or you can, if you have money, a lot of money, you can buy once, and then each 2 months or 6 months, whenever you have more money, you see the stock or this company. Is it going up? You put more. You invest more in it because it's going up. Now, if the company is losing money, it means you buy it at 40. Now it is 20. Are you going to buy more? This is called averaging down. It means you buy when the stock is going down. This is not good because you have a loss. How can you put more money and maybe the stock will go down and you have a double loss? You lost 20% or 30%, then you put more money on it, and then you lose 10 or 20%, and then you see that all your money, you lose your money and you lose your time. So my idea, or my opinion, try to see companies that are going up. It doesn't go up like never go down. There is small corrections, but small correction, it's not a sell off. Sell off is when the big investors, they began to sell because they know something about the company. I will give you an example. For example, Twitter. It has a high just 1 year or 2 years ago, $74. In general, $70 something. Now, let's say it's 26. What do you think? Do you think the company is going up or down? It's going down. Now, when it is going down, are you going to put more and more and more? And it's going down and down and down. You are losing money. So, at least see companies that are developing up, going up. You see a company 5 years ago, it was 10. Now it is 30. What do you think? Okay, this company is making money. So try to check these companies. Maybe it has a good fundamentals and a good thing. So try always to see the price, because it is one of the most important things. This shows you that you are successful or you are a loser. And you can't control that. You can't control the market. And you say, no, I select a company, it goes up. No, you can't. Just you buy, you have the conviction, and then stay. Stay and try not to always daily or weekly to just go and check, or each minute you check. how your investment is doing. No, this is investing. This is not swing trading or day trading. Okay, you don't check it every day. But if you want to check, if you bought some companies, 3 months, try to see what's going on after 3 months when we have the earnings and the company files information. So go to the company and check what's this company is doing. Is doing good or is doing bad, and check the price. Is going up, going good. At least you make sure everything is right. Now, any stock or stocks, they have corrections, yes. But when a correction, it becomes a sell-off, and you see that the stock is going down, because down, you are losing more and more money in this company. Okay? Now, in general, this is what I'm saying about investing, but the decision should be yours. If you succeed, it is you. If you lose, it is you. And don't regret anything, because you can't control the market. You can't say, oh, if I bought this company, I will put 10,000, now I'm a millionaire. No, don't do that. Because you're just wasting your time. Because something that this company has done, it's done. So it's the past. So don't calculate things because of the past. But if you right now you buy $10 a stock, and after 10 years it is 200, okay, you are making money and you are successful, okay? Because you choose it in the right moment and you are right. You say to yourself, I am right. That's it. If you lose money, you say, I am wrong. Okay? I thought that the company is good, but after 10 years, it lost half of its money, or 70%, or I don't know. And I feel that this company will not go up again, so I'm selling. Selling depends on you. But some people, they can go until 50%. That's why investing, you have more risk in investing, because you will never know the result until 1 year, 2 years, 5 years, 10 years. So you are losing. If you lose two things. You lose money. Let's say you buy a company at $20. After 10 years, it is 10. It just go up a little bit, go down a little bit, until it comes at $10. That's it, what the company has done. The whole 10 years. Now, so you don't just lose 50% of your money. You lost 10 years of investment. That's why some people, they don't buy single stocks, because they say, oh, they are risky. And because if you buy mutual fund, okay, it depends on the manager, if he's a good manager or bad, okay, and going up, going down is slower than single stocks. Single stocks, they can become volatile. And I have showed you before in my videos, PCYC, a company that was $3 2 years ago, 2 years and a half. And then now it is 265. In general, I didn't check the price because it's over. Okay? $3, it changes to be 265. 200 from 200. It means that the potential of making money in the market is big, but you don't know where is the big money. No one knows. No one knows where is the big money. So don't try to guess. You can speculate, you can study and buy, and then wait and see if you are right. But there is no sure thing. But in terms of risk, you have the options to use whatever you want. Are you going to buy the whole market, ETF, or are you going to buy mutual funds in some sectors that you like? For example, let's say you like insurance, and you know that insurance going up a little bit up. It's not that much up, but it's not that much down, and you see, oh, I am safe here. Okay, you buy mutual funds that have insurance companies only, or an ETF that follows the sector or the industries of insurance companies. And this is very easy. Okay, you go to my chart and then you check for ETFs and take one or two or three or four and go and find information about them, and that's it. They show you because in the mutual funds there is a manager. A manager is always changing stocks. Okay, changing. The losers, they get rid of them and he buys more, and the successful stocks he leave them for a certain time. Okay, but an ETF, it's different. It tracks an index. Either it goes up, you see your money up. If it goes down, your money is down. And if you go to my training about how to search for stocks, or how to buy from support, or wherever training you do, it will show you when to enter a stock, when to buy it, and then wait. If you are right, you will see the money. If you are wrong, you will lose little money if you exit very quick. This is it in swing trading. Okay, so there is another option, but those who have money. But in my YouTube channel, I'm trying to address for the general people, or what we call the public. It means you don't have that much money, but people who have a lot of money, they go to what we call a hedge fund. Now, a hedge fund is a big trader, and he has a record of making a good percentage of the market. So the rich, they give him money, and there is certain negotiations and how much money you can put and what is your percentage, and they go with the hedge fund. But most of you, I know, you can't go with a hedge fund because it's too much, like $500,000 or 1 million or 10 million to spend and to give it to someone that you should trust. But even if he lost money, the guys, it's a contract that he can't lose. It's a human. Okay, so there is no the people, they don't go after him because it's all in the market. It's a proven thing. Okay, it's not money that is taken from account and he plays with it elsewhere. It's all in the account, and it's proven that he was trading and he was investing. Okay, so this is all about investing today. Please, if you have questions related to investing, just comment here, thumb it up, and subscribe if you don't, and try just to share wherever, to share this video or this information with other people, your friends, for example. At least you spread the word and let people understand what's going on in the stock market, because a lot of people, they just throw their money and then they lose a lot of money, but they don't know how do they do it, or how do they lose their money. And this is a very bad thing, because knowledge is power and money. When you know something and you practice it and you make money, you can do a lot of stuff. So thank you very much and have a good day.